Welcome back to the edge of the abyss. Tonight, the water is dark, but the promises are made of gold. There are moments in financial history so catastrophic, so complete in their destruction, that they do not merely erase fortunes, they erase belief itself. Entire philosophies of wealth collapse in their wake. Civilizations that once felt certain about the nature of prosperity suddenly discovered that their confidence, their ambition, their sense of what was possible was built on little more than air. The South Sea bubble of 1720 was one of those moments. It was not simply a company that failed, nor merely investors who were foolish, or a government that chose to look the other way. It was something deeper, a story about the most dangerous vulnerability in all of economic life, the vulnerability of collective belief. Because great bubbles do not grow on fraud alone, though fraud is often present. They do not grow on ignorance alone, though ignorance always plays its role. What they require above all else is something far more seductive, the quiet human hope that this time wealth will come easily, that this time the numbers will only move in one direction, and that those who warn of danger simply do not understand the magnitude of what is happening. In the spring of 1720, that hope spread through London like a fever, not a plague of the body, but of the mind. Men who had never speculated in their lives sold their homes, their land, and their family silver for a single piece of paper, a share in the South Sea Company. Members of Parliament, the very men meant to regulate the company, were quietly granted shares at special prices, a form of corruption so refined, so systematic, that it would not look out of place in the boardrooms of the 21st century. The king himself became a governor of the enterprise. Clergymen invested the savings of their parishes. Widows liquidated their last security. Merchants abandoned generations of hard-earned prudence because the mathematics of the moment made caution appear foolish. And the price rose. Then it rose again and again. At its height, the company was valued more than the entire productive output of England. By any rational measure, it was impossible. And yet the price kept climbing, because the price kept climbing. Speculative manias possess a strange, almost biological appetite. They consume skepticism first, then caution, and finally the savings of an entire society. When the collapse came, as all bubbles eventually must, it arrived with a violence that shattered London's financial world. Fortunes that existed in June had vanished by October. Some among the gentry chose death over ruin. And one of the greatest minds in human history was not spared the madness. Sir Isaac Newton had once sold his shares early, walking away with a handsome profit. But as the mania accelerated, even he was drawn back into the rising tide. He bought again, near the peak. When the crash came, he lost a fortune that would equal millions today. in the ruins of that disaster, Newton reportedly offered a sentence that has echoed through financial history for 3 centuries. He said, "I can calculate the motions of the heavenly bodies, but not the madness of people." And tonight, we return to that moment, to the city where fortunes were built on paper promises, and where the sea, as it always does, eventually took everything back. So as the waves of history begin to lap gently against your mind, let the weight of your day dissolve. You are safe here. We are merely watching the bubbles rise before they inevitably burst. Before we descend fully into the madness of the great crash, let your presence be known in this quiet space. If these stories help you find stillness, subscribe to Capital Calm and join our circle of silent observers. And tell me in the comments, if you had lived in London in 1720, would you have sold everything for the dream? Or would you have stood quietly on the shore, watching the flames from the distance? Your thoughts keep the lanterns lit for those still searching for rest. Now, let the water take you. Let the gold turn slowly to lead, and let yourself drift. To understand how the South Sea bubble still matters today, one must look beyond the spectacle of the crash itself. It is tempting to treat the event as a historical curiosity, a strange moment of 18th century foolishness safely locked away in the archives of economic history. A cautionary tale, occasionally retrieved in introductory economics lectures before being quietly returned to the dust of the past. But the truth is far more unsettling, because the South Sea bubble was not simply a speculative excess. It was the first modern demonstration of a far more sophisticated phenomenon. The moment when a sovereign government, drowning beneath the weight of its own debt, discovered a method of shifting that burden onto the public through the machinery of a stock market boom. Not through taxation, not through open default, but through something far more elegant, a carefully engineered mania. At its core, the mechanism was deceptively simple. Government debt, which had grown enormous after years of expensive European wars, would be exchanged for shares in a private company. Investors who held government bonds would trade those bonds for stock in the South Sea Company, a corporation that promised vast future profits from trade in the Spanish Americas. On paper, the arrangement appeared ingenious. The government would reduce its immediate debt burden. Bondholders would gain access to what seemed like a far more lucrative investment, and the South Sea Company would emerge as a financial giant, entrusted with managing the newly converted obligations. But the true engine of the scheme was not trade, it was belief. Because once the shares began to rise, once the public saw fortunes appearing almost overnight, the transformation of debt into equity became something else entirely. It became speculation. And speculation, when mixed with hope and easy credit, possesses a remarkable power. It can persuade entire societies to believe that rising prices are proof of permanent prosperity. This is why the story of 1720 matters today, because the underlying architecture of the South Sea scheme did not vanish when the bubble burst. It simply changed its clothing. The same mechanism appeared almost immediately in France, where the Scottish financier John Law constructed the famous Mississippi bubble. A century later, it returned during the railroad manias of the 1840s, when vast infrastructure dreams drew enormous pools of speculative capital. It surfaced again in the land speculation that helped trigger the Panic of 1873. It reappeared in the roaring equity markets of the 1920s, and again, decades later, in the savings and loan crisis of the 1980s. By the late 1990s, it had evolved into the dot-com mania, a world in which companies without profits, without revenue, and sometimes without products were valued in the billions. And most recently, it revealed itself with devastating clarity in the mortgage-backed securities collapse of 2007 and 2008. Each crisis looked different on the surface. Each had its own characters, its own financial instruments, its own language of innovation and opportunity. But beneath the surface, the mechanism remained remarkably familiar. A problem of debt, quietly transformed into a problem of speculation. Asset prices inflated high enough to create the illusion that the system was functioning perfectly, until the moment when the illusion failed, and the losses, as they so often do, traveled downward, settling most heavily upon those least able to bear them. The stakes, therefore, are not merely historical, they are structural. They concern the uneasy relationship between governments and financial markets, between the incentives of political power and the economic well-being of ordinary citizens. They concern the delicate balance between the world of finance and the real economy that quietly supports it. And in our own time, those questions have returned with remarkable force. Across the world, sovereign debt has risen to levels that would have seemed impossible to earlier generations of economists. For more than a decade, central banks have kept interest rates unusually low, in part to ensure that governments can continue borrowing without immediate strain. Meanwhile, millions of individual investors, armed not with pamphlets from London coffee houses, but with smartphones glowing softly in the night, pour their savings into markets driven less by earnings than by expectation. The expectation that prices will continue rising and rising and rising still. In that sense, the South Sea bubble is not ancient history at all. It is the opening chapter of a story that has been repeating itself for 3 centuries. A story about debt, about belief, and about the extraordinary power of collective hope to inflate fortunes before quietly dissolving them once again into the sea. And to understand how this first great financial experiment began, we must return now to the Britain of the early 18th century, a nation victorious in war, but quietly suffocating beneath the weight of its own debts. To understand how the South Sea Company came into existence, we must rewind the clock. Not to the trading houses of London, not to the coffee houses where investors whispered over pamphlets and price sheets, but to the battlefields of Europe. Because the story begins not with speculation, but with war. The late 17th and early 18th centuries were an age of almost constant conflict among Europe's great powers. Empires fought not only for territory, but for trade routes, dynastic succession, and the delicate balance of continental power. England, like its rivals, had been drawn again and again into these struggles. Decade after decade, armies marched, fleets sailed, and governments borrowed. Among these wars, one proved especially costly: the War of the Spanish Succession. It began in 1701 and dragged across Europe for more than a decade, involving Britain, France, Spain, Austria, and several smaller states in a vast geopolitical contest over who would inherit the Spanish Empire. Battles were fought across the continent. Soldiers marched through Flanders and Italy. Naval fleets clashed across distant seas. Victory eventually came in 1713 with the signing of the Treaty of Utrecht. But victory had a price. By the time the fighting ended, the British government carried a national debt of roughly £50 million. To modern ears, the number may not sound extraordinary, but to the people of the early 18th century, it was almost unimaginable. A sum so large that even experienced financiers struggled to grasp its scale, and the machinery of government finance at the time was simply not built to manage such a burden. The roots of this problem stretched back nearly 2 decades earlier to one of the most important financial inventions in modern history: the founding of the Bank of England. The bank had been established in 1694 during yet another war with France. The Crown had discovered that traditional methods of raising money, royal loans from wealthy merchants or foreign bankers, were no longer sufficient to sustain the scale of modern warfare. So something entirely new was attempted. The government would borrow directly from the public. Ordinary citizens, merchants, landowners, even institutions could lend money to the state by purchasing government securities. These securities could then be bought and sold in an emerging secondary market. For the first time in history, the savings of an entire nation could be mobilized to fund the ambitions of its government. It was a revolutionary idea, and it worked. Britain suddenly possessed a financial system capable of sustaining wars that might otherwise have bankrupted the state. But every solution carries the seed of a new problem. Because borrowing from the public is easy, repaying the public is harder. And if the borrowing continues long enough, the debt begins to grow faster than the economy that must support it. By 1710, the British government faced an uncomfortable reality. Nearly £3 million per year were being paid in interest alone. That was almost half of the government's total annual revenue. The situation was not yet catastrophic, but it was unsettling. Serious financial minds across the kingdom could see the direction in which events were moving. Something would have to change. Various solutions were proposed. Some suggested renegotiating the interest rates on existing debt. Others argued for new taxes. Still others imagined entirely new financial institutions that might gradually absorb and manage the burden. It was in this atmosphere of anxiety, experimentation, and quiet political calculation that the South Sea Company was born. Not primarily as a trading enterprise, though it wore the costume of one, but as a tool of financial engineering. The company was formally chartered in 1711 during the Tory government of Robert Harley, the Earl of Oxford. Its official purpose was alluring. The company would conduct trade with the Spanish colonies of South America, regions long rumored to contain unimaginable wealth. Under the terms of the Treaty of Utrecht, Britain had secured a valuable concession known as the Asiento. This agreement granted Britain the right to supply enslaved Africans to Spanish colonial territories and to send one ship each year loaded with European goods to trade in Spanish-American ports. These were genuine commercial privileges, but their practical value was limited. Spanish colonial trade was tightly controlled, and the logistics were difficult. The profits promised by the company's promoters were optimistic. Yet the company's true purpose lay elsewhere. Behind the language of commerce, a more ambitious financial design was taking shape. The government allowed the South Sea Company to assume approximately £9 million of short-term government debt. Bondholders could exchange their government annuities, their claims on the Treasury, for shares in this new company. In effect, the state transformed debt into equity, a debt-for-equity swap conducted on a national scale. The architecture was undoubtedly clever. The government gained breathing room by restructuring part of its debt. The company received a steady stream of interest payments from the Treasury, and investors received shares in a glamorous enterprise, one decorated with visions of South American gold and imperial trade. On paper, the arrangement seemed almost elegant. Debt would become investment. Investment would become prosperity, and prosperity would solve the debt problem. But financial systems often appear most elegant in the moments just before they fail. Because what had been created in 1711 was not merely a trading company, it was a mechanism, a structure that combined government obligations, speculative markets, and public enthusiasm into a single fragile system. For several years, the machinery operated quietly in the background of British finance, but as the decade progressed, something began to change. Confidence grew, ambition expanded, and the directors of the South Sea Company began to imagine something far larger than a simple debt exchange, something that would transform their company, and soon the entire financial world of London. Because the true explosion of the South Sea bubble would not begin until 1720, and when it came, it would spread through London like wildfire. The years between 1711 and 1719 passed quietly for the South Sea Company. Not in total silence, of course. Ships sailed across the Atlantic, ledgers were maintained, offices in London bustled with clerks and correspondents. From the outside, the company appeared alive with commercial purpose, but beneath the surface, a quieter truth was beginning to emerge. The vast riches promised from trade with Spanish America never truly arrived. The company did possess the asiento, the contract allowing Britain to supply enslaved Africans to Spanish colonies, and that trade did produce some revenue. Yet the realities of 18th century commerce were stubborn things. The Atlantic was long and dangerous. Spanish colonial authorities were often hostile to British traders, and relations between England and Spain remained tense, sometimes drifting toward open conflict. The result was predictable. The profits from South American trade were far smaller than the company's promoters had once suggested. Ships returned with cargo, transactions were completed, but the dazzling wealth imagined in London pamphlets remained largely imaginary. Year by year, the gap between the company's projected prosperity and its actual earnings slowly widened. In retrospect, this was the moment when a more cautious institution might have paused. A sensible board of directors might have reconsidered its ambitions, adjusted its expectations, and rebuilt the company on a more realistic foundation. But the South Sea Company was never merely a trading enterprise. It was something far more complicated, a hybrid creature, part corporation, part political instrument. From the beginning, it had been deeply intertwined with the British government and with the interests of powerful men whose reputations and fortunes were connected to its success. The company's directors understood something important. The value of the South Sea Company did not truly depend on the cargo inside its ships. It depended on perception, on its close relationship with the government, and on the willingness of investors to believe that its shares were worth a great deal of money. The story of South American trade, with its glittering promises of gold and silver, was always useful, but it was, in many ways, a narrative, a story designed to justify a rising stock price, because the company's true importance lay elsewhere. It was, above all, a mechanism for managing government debt. And as long as investors believed the story, the mechanism could continue operating. Then, in the closing months of 1719, events across the English Channel changed everything. In France, a Scottish financier named John Law was performing what appeared to be a financial miracle. Law had persuaded the French government to adopt an extraordinary experiment. He established a central bank, he issued paper money, and he merged this financial system with a vast trading corporation, the Mississippi Company, which held a monopoly over French trade in Louisiana. At its heart, Law's system worked in a way that felt strangely familiar. Government debt could be exchanged for shares in the company. Investors could purchase those shares using government bonds, even if those bonds were trading below their face value. The result was powerful. Demand for shares surged, and because bonds could be used to buy those shares, demand for government bonds surged as well. Prices rose and rose again. Before long, Paris was gripped by one of the greatest speculative frenzies Europe had ever seen. The shares of the Mississippi Company climbed by astonishing multiples. Paper fortunes appeared almost overnight. So many people suddenly possessed wealth in the millions that the French language invented a new word for them: millionaire. The streets around Law's bank filled with crowds desperate to buy shares. Some men disguised themselves as servants simply to gain access to the offices where the transactions were taking place. For a brief moment, Paris believed it had discovered a new financial universe, a world in which debt could dissolve into prosperity and where wealth could expand without limit. From London, the spectacle was watched with fascination and with something else: envy. Because to British observers in late 19, John Law appeared not as a reckless speculator, but as a genius. France, it seemed, had discovered a way to solve its national debt problem through financial innovation. The directors of the South Sea Company studied the French experiment carefully, with admiration, with anxiety, and with opportunity. If France could refinance its national debt through a stock market boom, why could not Britain do the same? The British financial system was more orderly. Its markets were more developed. Its government was widely considered more trustworthy. Surely the same mechanism could work even better in London. Once the question was asked, the answer arrived quickly.
because the attraction of such a scheme was obvious. Not commercial logic, but the promise of effortless enrichment. And so, in January of 1720, the South Sea Company presented an audacious proposal to the British government. The company offered to assume responsibility for the entire national debt of Great Britain. At the time, that debt stood at roughly £31 million. In return, the government would agree to pay the company a fixed annual sum, and the company would be permitted to issue new shares to the public. Holders of government annuities, the very bonds that represented Britain's debt, would be invited to exchange those annuities for shares in the South Sea Company. On the surface, it looked elegant. Debt would become investment, bondholders would become shareholders, and the burden of government borrowing would be reorganized within the structure of a private corporation. But hidden within the mathematics of the proposal was a crucial detail. The company's profit depended almost entirely on the price of its own shares, which meant that the directors of the South Sea Company possessed the most powerful incentive imaginable to make that price rise and to keep it rising by whatever means were available. And soon, London would discover just how far those means would extend, because once the proposal was accepted, the directors began to do something extraordinary. They began to manufacture a market.
At the heart of the South Sea scheme lay a mechanism that, beneath its elegant financial language, was remarkably fragile. Strip away the legal documents, the parliamentary approvals, the language of imperial trade, and what remained was something far simpler, an enormous structure of financial leverage. A structure so delicate that it could survive only as long as one condition remained true: confidence. Confidence in the price of the company's shares. Once that confidence faltered, the entire mechanism would begin to unravel. To understand why, we must look closely at the mathematics of the mania. At the beginning of 1720, shares in the South Sea Company traded at roughly £128. It was already a respectable price, but when the company's grand proposal to assume the national debt was accepted by Parliament in April, something remarkable happened. The market erupted with enthusiasm. Investors rushed to buy shares. The price began to rise. At first, the increase seemed natural, the result of genuine excitement about the company's ambitious plan. But behind the scenes, the directors were doing something very deliberate. They were buying their own stock, using borrowed money, money secured against the rising value of the shares themselves. It was a circular mechanism. The rising price justified more borrowing. The borrowed money purchased more shares, and those purchases pushed the price even higher. A loop of optimism feeding upon itself. Modern observers might recognize the pattern immediately. The technique would later appear in corporate share buyback programs, in margin lending during the stock market boom of the 1920s, and in more recent decades in various forms of leveraged financial speculation. But in 1720, it felt like innovation. And innovation is often indistinguishable from brilliance until the moment it fails. The directors employed another tool as well, one that was less financial and more political. Before the debt conversion scheme even passed through Parliament, shares in the South Sea Company began quietly appearing in the accounts of influential people. Members of Parliament, officials in the King's household, even members of the royal family. These shares were not purchased in the ordinary sense. They were granted at prices far below the market value. Sometimes they were placed into accounts that existed only on paper, with the understanding that when the price inevitably rose, the profits would be distributed. It was bribery, but a particularly refined form of bribery. Instead of envelopes of cash, there were financial instruments. Instead of immediate payment, there was the promise of future profit. And it worked beautifully. Opposition inside Parliament faded. The legislation passed with remarkable ease. Even the Chancellor of the Exchequer, John Ainslavey, had received shares under these arrangements. His enthusiastic support for the scheme, therefore, was perhaps understandable. Meanwhile, the share price continued its astonishing climb. Speculation spread across London, and the company encouraged it, because the higher the share price rose, the more profitable the entire scheme became. The directors even began lending money directly to investors. A person who wished to purchase shares but lacked sufficient funds could borrow from the company itself, using the very shares they were buying as collateral. In effect, investors could speculate with money they did not possess, a powerful accelerant for any market bubble. And so the price surged upward. By May 1720, South Sea shares had reached £550. By June, they climbed to £890, and by early August, the price peaked at just over £1,000 per share. In only 7 months, the stock had risen more than 700%. At that price, the South Sea Company was valued at roughly £170 million, a staggering figure. In fact, the valuation exceeded the entire annual economic output of England. By any reasonable measure, the numbers made no sense at all. But speculative markets rarely operate according to the logic of reason. They operate according to something else: momentum and narrative. A powerful story, repeated often enough, can override almost any calculation. The story in 1720 was simple: South American riches, government backing, and a share price that kept rising. That was enough. It was enough in the coffee houses of Exchange Alley, where investors gathered to trade. And it would be enough centuries later in the internet chat rooms of the dot-com boom and in the glowing cryptocurrency exchanges of the modern era. The technology changes, but the emotional architecture remains remarkably constant. By the summer of 1720, speculation had spread far beyond the South Sea Company itself. Its success created an entire ecosystem of imitation. New ventures appeared almost daily. Contemporaries called them bubbles, enterprises that looked solid from the outside but contained nothing but air. Some proposed importing jackasses from Spain. Others promised the construction of perpetual motion machines. One of the most famous ventures offered shares in a company whose prospectus described its purpose only as an undertaking of great advantage, but nobody to know what it is. Even so, investors rushed forward. The promoter reportedly raised £2,000 in a single morning, then disappeared, which, under the circumstances, may have been the most rational financial decision anyone made that summer. Eventually, the chaos became impossible for the government to ignore. Dozens of questionable companies were competing for investors' attention. Fraud was becoming obvious, and the credibility of financial markets themselves seemed at risk. So, in June of 1720, Parliament intervened. It passed legislation known as the Bubble Act. The law made it illegal to form a joint stock company without a royal charter. Many of the smaller speculative enterprises collapsed almost immediately. On the surface, it seemed like a restoration of order, but the act carried an unintended consequence. By exposing the fraudulent nature of many speculative ventures, it encouraged investors to ask a dangerous question. If so many companies were empty, what about the South Sea Company? And for the first time, people began to look carefully, to examine the numbers, to question the assumptions, and what they discovered was not reassuring. Because the greatest bubbles rarely collapse all at once. First, someone begins to doubt, then someone else, and eventually, the crowd begins to turn.
The parallels between the South Sea bubble and the financial world we inhabit today are not merely poetic. They are not loose metaphors or convenient historical comparisons. They are structural. The same mechanisms that created the mania of 1720, debt, leverage, government involvement, and the delicate psychology of belief, continue to shape modern markets with remarkable fidelity. To see this clearly, we begin where the South Sea story itself began, with debt. In the early 18th century, the British government faced a burden that seemed immense by the standards of the time. A national debt so large that policymakers feared it might eventually overwhelm the state's finances. The solution they attempted was ingenious. Rather than reduce the debt directly, they attempted to transform it. Government obligations would become shares in a company. Debt would become equity, and rising asset prices would create the financial space necessary to make the transformation appear successful. The entire scheme depended upon one critical condition. The share price had to keep rising, or at the very least, remain elevated. Because if the market price fell below the level required to sustain the mathematics of the conversion, the illusion would dissolve. And when that happened, the debt would still remain. 3 centuries later, the structure of modern financial policy reveals an eerily familiar pattern. Following the global financial crisis of 2008, governments and central banks confronted another enormous accumulation of debt. This time, the response took a different form. Interest rates were lowered to levels rarely seen in financial history. Central banks began purchasing vast quantities of government bonds, a policy known as quantitative easing. The stated objective was to stabilize financial markets, to restore confidence, and to encourage economic growth. But the practical effect was something quite specific. Asset prices began to rise. Stocks climbed. Bond prices remained unusually high, and the cost of servicing government debt fell dramatically because interest rates remained suppressed.
In other words, the stability of the financial system began to depend increasingly on the continued elevation of asset prices, just as the South Sea scheme depended on the continued elevation of its share price. In both cases, the system worked as long as confidence remained intact, and as long as the policies supporting that confidence appeared permanent. But the parallels do not end with government debt. They extend into the mechanics of speculation itself. Consider the role of easy credit. One of the most powerful accelerants of the South Sea bubble was the company's willingness to lend money to investors who wished to purchase its shares. An investor could buy stock using borrowed funds, with the shares themselves serving as collateral. The arrangement dramatically expanded the number of participants in the market. People who lacked sufficient savings now could speculate, and speculation, once democratized in this way, tends to grow with extraordinary speed. The same structure has appeared repeatedly throughout financial history. During the great American stock market boom of the 1920s, investors could purchase equities with as little as 10% of the purchase price in cash. The remaining 90% could be borrowed from brokers. This system, known as margin lending, produced an extraordinary expansion in stock ownership. But it also created an invisible fragility, because when prices began to fall, investors received margin calls. They were required to repay their loans or sell their shares. Those forced sales pushed prices even lower, which triggered more margin calls, which forced more selling. A feedback loop of declining prices and expanding panic. It is perhaps the most predictable and the most violent mechanism in financial markets, a cycle that has appeared again and again. In the collapse of 1929, in the unwinding of speculative hedge fund trades decades later, and even in the sudden liquidations seen in modern cryptocurrency markets, where leverage can reach extraordinary levels. The tools change, the screens glow brighter, the markets operate faster, but the underlying architecture remains remarkably familiar. Because the central driver of speculative bubbles has never been technology. It has always been human psychology, the belief that rising prices confirm the wisdom of the crowd, the assumption that this particular moment, this particular innovation, this particular market is different from all those that came before. And so the story repeats itself across centuries, across technologies, across entirely different financial systems. The South Sea bubble was simply the first time the full pattern appeared in modern form. The first moment when government policy, financial engineering, leverage, and mass psychology combined into a single explosive structure, a structure capable of generating enormous paper wealth and equally capable of erasing it. And in the quiet that follows a bubble's collapse, societies often ask the same question: how could so many intelligent people believe something so fragile? But the deeper question may be different. Not why people believed, but why they continue to believe again and again and again. Behind the familiar story of the South Sea bubble, the excited investors, the soaring share prices, and the eventual collapse, there exists another layer of the narrative, a quieter layer, one composed not of crowds and speculation, but
of institutions, power, and relationships carefully woven behind the visible machinery of the market. To examine these forces is to discover something important, not only about the crisis of 1720, but about the deeper architecture of financial capitalism itself. Because the South Sea Company was never simply a corporation, it was something more intimate and more complicated. From its earliest days, it existed as a public-private partnership in the most literal sense, a private enterprise whose fortunes depended entirely upon its relationship with the government. Its share price rose because Parliament endorsed its scheme. Its authority derived from the Crown. Its directors moved comfortably within the same political circles that governed the nation. The company's most valuable asset was not its ships, nor its trade, nor even the government debt it had been allowed to absorb. Its greatest asset was something less tangible: access. Access to power, access to decision-makers, and access to the symbolic authority of the British state itself. That authority became one of the company's most effective marketing tools. When investors purchased shares in the South Sea Company, they were not merely buying into a commercial enterprise. They were buying into something that appeared almost governmental, a venture cloaked in legitimacy, protected by political influence, and supported, at least in appearance, by the machinery of the state. The distinction between public interest and private profit slowly blurred until it became almost impossible to see where one ended and the other began. This fusion of financial power and political authority may seem troubling, but it is not unique to 1720. In fact, it is one of the most persistent features of financial history. Again and again, during moments of speculative excess, private institutions have formed relationships with governments that benefit both parties, while transferring the ultimate risks to the public. In the 1980s, during the American savings and loan crisis, deregulation allowed financial institutions to take increasingly dangerous risks. The policy changes that made this possible did not appear by accident. They were encouraged by political lobbying, campaign contributions, and the quiet influence of the very industry that would later collapse. When the losses finally emerged, they amounted to hundreds of billions of dollars, and the cost was ultimately borne by taxpayers. The pattern appeared again during the financial crisis of 2008. Major financial institutions had developed complex securities tied to mortgage markets. Regulatory agencies were meant to oversee these practices. Yet many of the individuals designing the regulations had previously worked within the same financial institutions they were meant to supervise. Others would later return to those institutions. This movement between private sector and regulatory agencies, sometimes called the revolving door, created an environment in which oversight became complicated, technical, and at times hesitant. Risk accumulated slowly, almost invisibly, until the system finally broke. These patterns echo the relationships that surrounded the South Sea Company 3 centuries earlier. Different institutions, different technologies, but the same underlying tension.
between private profit and public responsibility. Even the Bank of England, still a relatively young institution in 1720, found itself caught inside this web of competing interests. The bank had once hoped to manage the national debt itself. It had proposed its own plan to the government, but that proposal had been rejected in favor of the South Sea Company's scheme. This left the bank in an unusual position. On one hand, it remained a competitor. On the other, it shared a powerful interest in preserving confidence in British financial markets. If the South Sea Company collapsed too violently, the credibility of the entire financial system might collapse with it. And so the leaders of the bank faced an uncomfortable reality. They were both rivals and reluctant partners. When the bubble finally began to deflate in August and September of 1720, the Bank of England had to decide how to respond. Should it intervene? Should it attempt to stabilize the market? Should it support the South Sea Company or allow the collapse to proceed? These questions were extraordinarily difficult, not because the directors of the bank lacked intelligence, but because the situation itself was unprecedented. Central banking was still a young concept, no established doctrine explaining how such crises should be managed, no historical playbook, no tested emergency procedures. The leaders of the bank were forced to improvise, to make decisions that would affect the entire financial system, without knowing whether their choices would calm the panic or deepen it. This moment, the central bank acting as an institution of last resort, deciding in real time which institutions to support, at what cost, and for whose benefit, would become one of the defining dilemmas of modern finance. And it is a dilemma that remains unresolved. The questions raised in 1720 did not disappear. They reappeared during the Great Depression of 1929. They resurfaced during the financial crisis of 2008, and they continue to shape debates about economic policy even today. When should a central bank intervene to prevent a financial panic from becoming a broader economic collapse? If intervention becomes necessary, who should bear the cost? The institutions whose risks created the crisis? The governments that enabled those risks? Or the public, whose savings and livelihoods are most vulnerable when financial systems fail? 300 years after the South Sea Company began engineering its magnificent and disastrous scheme, these questions remain among the most important in economic life, and perhaps also among the most difficult to answer, because every financial system rests on a delicate balance between innovation and restraint, between private ambition and public trust. And when that balance tilts too far in one direction, the consequences can echo across centuries.
The summer of 1720 marked what historians of finance often call the terminal phase of a speculative bubble. This is the moment when the contradictions inside the system, the tensions quietly building beneath the surface, become too large to ignore. A moment when the structure begins to strain under its own weight, and when even the smallest disturbance can begin a collapse that no one,
not the architects of the system, nor the authorities tasked with supervising it, can easily prevent. To understand how the South Sea bubble entered this final phase, we must look beneath the spectacular rise of its share price and examine the fragile machinery that had been assembled beneath it. Because by the summer of 1720, the company had done something very deliberate. It had multiplied the number of investors without multiplying the amount of actual money in the system. This was accomplished through a series of subscription rounds, 3 separate public offerings of new shares, each offered at a higher price than the last, each purchased with extraordinary enthusiasm. The first subscription, offered in April, priced shares at £300, but investors were not required to pay the full amount immediately. Only 10% of the purchase price was due at first. The remainder could be paid later, in installments. A month later, a second subscription appeared, this time at £400 per share. Once again, investors could defer most of the payment. Then, in June, a third subscription was offered. The price had now reached an astonishing £1,000 per share, and still, the deferred payment structure remained. These installment plans were not minor details. They were the very engine of the speculation, because they allowed investors to commit to purchases they could not actually afford. The expectation was simple. The price would continue to rise, and before the installment payments came due, the investor would sell the shares to someone else at a profit. In effect, the South Sea Company was not selling long-term investments. It was selling something closer to bets on the continued rise of the share price. As long as the price climbed, everyone could exit with a profit. But beneath this optimism lay a precise and dangerous reality. The installment payments for these subscriptions were scheduled to begin in the autumn of 1720. When those payments arrived, investors would face a stark choice. They could find the money to complete their purchases, or they could sell their shares into whatever market existed at that moment. As long as confidence remained strong, this system might have continued. Buyers would appear, prices would hold, installments would be paid. But if confidence faltered, even slightly, the entire structure could reverse itself. Sellers would appear, prices would fall, and falling prices would create more sellers. The feedback loop that had lifted the market upward would simply begin operating in the opposite direction. And once that process began, it would accelerate with extraordinary speed. The shift began quietly. In late July and early August, several of London's most sophisticated investors began selling their shares. These were not reckless speculators. They were experienced men, deeply connected to the inner workings of the financial world. Men who had good reasons to understand the company's actual commercial prospects. Their selling was discreet, conducted through multiple brokers, carefully designed to avoid alarming the market. At first, the impact seemed minor, but their departure reduced something essential: buying pressure. And in a speculative mania, a price that stops rising has already begun to fall. By early August, South Sea shares had declined from their peak of just over £1,000 to roughly 850, a drop of about 15%. Against the backdrop of a 700% rise, it might have appeared insignificant, the sort of correction markets often experience. But the financial structure of the bubble was too fragile for such comfort. Because thousands of investors had purchased shares with borrowed money or through installment obligations, their profits depended on continued price appreciation. When the price stopped climbing, anxiety began to spread, and anxiety soon becomes something else. By the middle of August, the price had fallen to around £700. By early September, it dropped to 400, and by the end of the month, the collapse was unmistakable. Shares traded near £150, almost exactly where they had been before the mania began. In less than 3 months, the illusion of limitless wealth had dissolved. The speed of the collapse was not accidental. It was the direct consequence of leverage. Every borrowed pound used to buy shares became, as prices fell, a pound of loss that exceeded the investor's own capital. And because the company itself had lent money against the shares, the falling price created a cascade of financial pressure. Loans secured by shares suddenly lacked sufficient collateral. Lenders demanded more security. Investors could not provide it, and so the shares were sold forcibly into a declining market, which drove prices lower still and triggered further collateral demands, a spiral of liquidation. The same pattern would appear again and again across financial history. During the crash of 1929, during the collapse of long-term capital management in 1998, during the mortgage-backed securities crisis of 2008, leverage transforms speculation into systemic crisis. Because when prices fall, sellers are no longer acting voluntarily. They are forced to sell, and forced sellers accept almost any price. The consequences spread quickly through the broader financial system. London's goldsmiths and private bankers, who had extended credit to investors, suddenly held collateral worth only a fraction of the loans they had issued. Several private banking houses failed outright. Credit contracted rapidly, lending slowed, and the effects moved outward beyond the speculative market. Merchants struggled to obtain financing. Trade slowed. Ordinary commercial life felt the shock. This transmission from speculative markets to the real economy through the contraction of credit is one of the oldest patterns in financial history. And in 1720, the template appeared with startling clarity. The political consequences were equally dramatic. Parliament was recalled from recess. Investigations began almost immediately. What they uncovered shocked even a society accustomed to political intrigue. The distribution of secret share accounts, bribes disguised as preferential stock allocations, falsified records designed to conceal the company's true financial position. Robert Knight, the company's cashier, the man who had carefully managed the secret accounts of politicians, fled to the continent before he could be arrested. His escape was widely interpreted as evidence that many powerful men preferred his silence. The Chancellor of the Exchequer, John Aislabie, less fortunate. He was expelled from Parliament, condemned for most notorious, dangerous, and infamous corruption, and committed to the Tower of London, the first senior British government minister ever punished for financial corruption, but certainly not the last. The investigation also triggered one of the most important debates in early modern economic policy. What responsibility did the government bear for the disaster that had unfolded? After all, the scheme had not been a private enterprise alone. It had been endorsed by Parliament, supported by political leaders, promoted with the authority of the state itself. If investors had been ruined, to what extent was the government responsible? Parliament attempted partial solutions. Some investors received limited compensation from the company's remaining assets. The Bubble Act remained in force, and a more cautious attitude toward joint stock enterprises spread through British political culture. But the deeper questions remained unresolved, questions that still echo through financial history today. How much freedom should financial markets possess? How much oversight should governments impose? And when a speculative system collapses, who ultimately bears the cost? The architects of the scheme? The politicians who enabled it? Or the public, whose savings and livelihoods lie at the far end of every financial chain? These questions first emerged with clarity in 1720, and 3 centuries later, they remain among the most difficult questions in economic life. Because every bubble, once it reaches its terminal phase, reveals the same truth. The rise is built on belief, but the collapse is built on mathematics.
At the center of the South Sea bubble, there is a truth that stretches across 3 centuries and speaks to the present with an unsettling clarity. It is not a story about greed. Greed was certainly present, but greed alone does not build systems capable of moving entire nations. It is not a story about fraud. Fraud was abundant, brazen, and carefully organized, but fraud by itself rarely sustains a market-wide illusion. And it is not even a story about irrational markets. Markets, after all, have always possessed the capacity for extraordinary excess. No, the deeper truth of the South Sea bubble is something far more structural. The bubble was not an accident. It was not an anomaly. It was a predictable outcome of a particular set of conditions. Conditions that have appeared again and again throughout the history of financial capitalism. Conditions that, despite centuries of reform and regulation, continue to appear today, because the incentives that create them have never been fundamentally altered. These conditions can be described with surprising precision. The first condition is simple: a government carrying a level of debt that becomes increasingly difficult to manage through ordinary means. When this happens, political leaders begin to search for extraordinary solutions. Financial innovation becomes attractive. Complex schemes promise relief, and the boundary between public policy and financial experimentation begins to blur. The second condition is the presence of a financial sector capable of designing those solutions, a sector possessing both technical sophistication and political access, a sector able to propose arrangements that appear to solve the government's immediate problems while quietly transferring the deeper risks to the public. The profits of such arrangements tend to concentrate in private hands. The dangers disperse across society. The third condition involves regulation. Sometimes the regulatory system is directly captured by financial interests, as it was in 1720, when the same political figures responsible for approving the South Sea scheme were themselves beneficiaries of the shares it produced. At other times, the capture is more subtle. Regulators become convinced by prevailing economic theories that systemic risk is unlikely or even impossible. Such intellectual capture occurred in the years preceding the 2008 financial crisis, when many policymakers believed that modern financial engineering had made large-scale collapses improbable.
The fourth condition concerns memory. Financial disasters leave deep scars, but those scars fade with time. As one generation retires, another emerges. A generation that has heard of past crises, but never personally experienced them. And without the restraint produced by lived memory, the psychological forces of speculation return. Momentum, narrative, social contagion. The belief that rising prices represent not danger, but confirmation. To fall, but confirmation. Which leads to the fifth condition, perhaps the most powerful of them all. A prolonged period of rising asset prices. When markets climb for many years, they begin to shape expectations. Investors who enter the market during these periods experience only success. To them, rising prices appear normal, even inevitable. Caution begins to look irrational, and continued participation begins to look like wisdom. These conditions were present in England in 1720. They appeared again in the United States in 1929, and they resurfaced across much of the developed world in the mid-2000s. Their presence is often a better guide to systemic risk than the confident reassurances of institutions, central banks, credit rating agencies, finance ministries. Again and again, these authorities have failed to recognize systemic danger until it was already too late. But perhaps the most revealing figure in the South Sea story is not a politician, nor a company director. It is Isaac Newton. Newton is often invoked as a cautionary tale, the greatest scientist of his age, undone by a speculative mania. Yet the deeper lesson of Newton's experience is not about the limits of intelligence. It is about the limits of individual rationality. Newton understood the mathematics of the universe. He recognized early that the South Sea share price had risen beyond any rational valuation, and so he sold his shares. He sold them at a profit. By every analytical measure, he had acted correctly. But then something remarkable happened. The price continued to rise, and Newton watched as acquaintances, men far less intellectually accomplished than himself, accumulated fortunes far greater than his own. Day after day, the spectacle continued. Eventually, he returned to the market, not because his analysis had changed, but because the social and psychological pressure of watching others become wealthy had become too great to ignore. He re-entered the market near its peak, and when the bubble collapsed, he suffered enormous losses. Later, Newton is said to have remarked, "He could calculate the motions of the heavenly bodies, but not the madness of people." The episode reveals something profound about speculative markets. Recognizing a bubble is not enough, because identifying irrationality does not protect an investor from the consequences of acting too early. In speculative markets, being right too early can look exactly like being wrong, and the social pressure created by visible wealth can slowly erode even the most disciplined judgment. This dynamic was later captured by the economist John Maynard Keynes, who famously observed that markets can remain irrational longer than investors can remain solvent. But the observation is not merely about markets. It is also about the pressures placed upon individuals, the pressure to participate, the pressure to avoid appearing foolish, the pressure to join the prosperity that seems to surround everyone else. The directors of the South Sea Company understood this instinctively. Their most powerful promotional tool was not advertising, it was the rising share price itself. Every new price increase became a form of marketing. Every investor who became wealthy provided visible evidence that the scheme was working. And this information spread rapidly through the networks of London coffee houses, newspapers, and daily conversation. Speculation fed on its own success. The directors merely needed to sustain the process long enough to exit with their own fortunes secure. They employed every method available: market manipulation, political influence, and the suppression of inconvenient financial information. This final element, the concealment of financial reality, is another structural feature of nearly every speculative bubble. Inside the South Sea Company, financial records were falsified. The extent of loans made against shares was hidden. The true magnitude of political bribery was concealed. Investors operated with incomplete information, and this information asymmetry allowed insiders to leave the market early while the public continued to buy. The same architecture appeared centuries later during the financial crisis of 2008. Complex instruments such as mortgage-backed securities and collateralized debt obligations were constructed with layers of complexity so deep that even sophisticated investors struggled to understand their true risks. Credit rating agencies assigned reassuring grades based on models that underestimated those risks, and the information gap between financial insiders and the public widened dramatically. In both cases, the bubble depended on the same principle. Those who understood the structure could escape. Those who did not remained exposed. And so the ultimate lesson of the South Sea bubble is that speculative manias are not rare anomalies. It is that they are recurring products of financial systems themselves. Regulators may attempt to prevent them. Analysts may attempt to warn against them, but both groups operate within the same incentive structures that allow the bubbles to form. Regulators can be captured. Analysts can be influenced by the institutions that employ them, and institutional memory fades as the generation that experienced the last crisis gradually disappears. The incentives remain. The psychology remains, the structure remains, waiting for the next opportunity to assemble itself. Which is why the South Sea bubble remains so relevant today. Not because the world has failed to improve since 1720. Financial regulation has evolved in meaningful ways. Markets are larger, more complex, and more carefully supervised. But the deeper structure of the problem has not changed. Governments accumulate debt. Financial markets offer solutions. Private profits are concentrated. Public risks are dispersed. And the human desire to believe that wealth can appear without effort continues to shape the behavior of investors. 3 centuries after the South Sea bubble, the same forces still operate, quietly, patiently, waiting for the moment when rising prices begin to look, once again, like certainty. And when that moment arrives, history rarely repeats itself exactly, but it does, with remarkable consistency, rhyme.
In the years that followed the collapse of the South Sea bubble, the English financial system did what financial systems have always done after catastrophe. It rebuilt itself, not through dramatic transformation, but through a familiar combination of institutional pragmatism and selective amnesia.
The panic subsided. The investigations concluded, and gradually, the machinery of commerce began moving again. One institution emerged from the crisis with its authority strengthened: the Bank of England. The bank had survived the turmoil without failing, and in the aftermath, it absorbed a portion of the South Sea Company's remaining obligations. In doing so, it established something historically important. For the first time in English financial life, a central financial institution had acted as a stabilizing force during systemic crisis. The idea that a central bank might intervene to preserve the stability of the entire system, rather than merely protect its own balance sheet, began to take root. Meanwhile, the national debt remained. It had been the original problem the South Sea Company was meant to solve. But debts of nations rarely disappear through grand schemes. Instead, they fade gradually, managed through taxation, fiscal discipline, and the slow expansion of the economy itself. The South Sea Company, stripped of its speculative ambitions, did not vanish entirely. It continued to exist for another century, but its role had changed. No longer a vehicle for financial dreams, no longer a magnet for speculative excitement, it became something quieter, an administrative institution managing residual government debt. The ambition that had once fueled its rise had been completely burned away. Sometimes, catastrophe does not destroy an institution. Sometimes, it simply removes the illusion that gave it life.
The political consequences of the collapse were equally profound. From the turmoil emerged a figure who would shape British politics for decades: Robert Walpole. Walpole had opposed the South Sea scheme from the beginning, and when the crisis erupted, he managed the government's response with considerable skill. His careful handling of the aftermath restored a degree of confidence to the financial system. In time, he would become what historians later recognized as Britain's first Prime Minister. The legitimacy of his long administration rested partly on a simple contrast: order replacing chaos, stability replacing speculation. Yet Walpole understood something essential. Restoring financial confidence required more than institutional reform. It required the appearance that the political class had learned its lesson. Parliament staged investigations, confiscated the estates of disgraced directors, and publicly condemned the corruption that had enabled the scheme. But beneath the surface, the deeper relationships between government and finance remained largely intact. The architecture that had made the South Sea bubble possible had not truly disappeared. It had simply become more cautious. It continued to exist for another century, but its role had changed. No longer a vehicle for financial dreams, no longer a magnet for speculative excitement, it became something quieter, an administrative institution managing residual government debt. The ambition that had once fueled its rise had been completely burned away. Sometimes catastrophe does not destroy an institution. Sometimes it simply removes the illusion that gave it life.
For the ordinary investors who had lost their savings, the ending was less reassuring. Eventually, a partial settlement was arranged. Fragments of their losses were repaid from the company's remaining assets after the confiscation of directors' fortunes. But the compensation was incomplete. It could never have been sufficient, because losses on the scale produced by a financial collapse cannot truly be recovered. They can only be redistributed, and the way they are redistributed is rarely determined by justice. It is determined by power. Those with political connections, those with legal expertise, those with enough surviving wealth to wait patiently for recovery, they recovered first. Those without such advantages, the widows, the small merchants, the clergy who had invested modest savings in hope of security, recovered last, and often hardly at all. There is a particular cruelty in the structure of financial manias. During the ascent, gains are concentrated. Early investors, insiders, those with superior information capture extraordinary profits. But during the collapse, losses spread outward. Late investors, ordinary participants, those who lacked the information needed to see the turning point, they bear the greatest share of the destruction. This asymmetry is not accidental. It is built directly into the mechanics of speculation, which means that the ultimate effect of many financial manias is not the creation of wealth, but the transfer of wealth from the many to the few. A transfer temporarily concealed by the paper fortunes created during the rise.
300 years have passed since South Sea shares traded above £1,000 in the coffee houses of Exchange Alley. During those centuries, humanity has constructed a financial system of extraordinary complexity. Central banks now possess explicit mandates to maintain financial stability. International regulatory bodies oversee global markets. Deposit insurance protects ordinary savers. Disclosure requirements demand levels of transparency that the directors of the South Sea Company could scarcely have imagined. An immense academic literature now explains how bubbles form, how leverage amplifies risk, and why speculative systems eventually collapse. All of this represents genuine progress, real improvements in our capacity to manage financial systems. And yet, the bubbles continue. They continue because the conditions that produce them are not simply failures of regulation. They are features of the system itself. Governments accumulate debt. Financial institutions design instruments to manage that debt. Information asymmetries persist. Leverage amplifies risk, and the incentives of powerful institutions often diverge from the interests of the broader public. These forces are structural, and structures, once built, tend to reproduce themselves. In the autumn of 1720, standing amid the wreckage of his investment, Isaac Newton reached a realization. Newton could calculate the movement of planets centuries into the future. He had described the fundamental forces governing the physical universe, but the financial markets had defeated him. He could not determine when the mania would end, nor protect himself from its consequences. His statement that he could calculate the motions of heavenly bodies, but not the madness of people, is often quoted as a charming anecdote, but it is something deeper.
It is a recognition of the nature of the system itself. Financial markets are not physical systems. They are social systems. They are shaped by psychology, by incentives, by power, and by the stories people tell themselves about wealth, risk, and opportunity. These forces are not easily reduced to equations. They change with culture, with politics, with time, but they never disappear.
Which is why the South Sea bubble is not merely a cautionary tale. It does not simply say, "These people were foolish, be wiser." Instead, it offers a more unsettling insight. The participants in the bubble were not fools. They were human beings, operating within structures that rewarded optimism, punished caution, and made it extraordinarily difficult to resist the collective momentum of the market. Many of them could see the danger approaching, but the system itself made meaningful resistance almost impossible. The lesson, therefore, is not that individuals must become perfectly rational. The lesson is that the structures surrounding them must account honestly for human behavior, for ambition, for fear, for the powerful temptation of easy wealth. Until that design exists, if it ever does, the pattern will continue. Debt will accumulate. Financial engineers will propose elegant solutions. Asset prices will rise. Warnings will be issued and quietly ignored. And somewhere, in the modern equivalent of the coffee houses of Exchange Alley, ordinary people will watch their neighbors grow wealthy on paper, and they will calculate, just as Newton once calculated, that perhaps the time has come to reconsider what is possible.
The heavens, as Newton showed, move according to laws that never change. The markets move according to something else entirely, something shaped by human imagination, by hope, by fear, and by the mysterious chemistry of crowds. 3 centuries of financial history have not fully explained it. No regulation has fully contained it. And in that quiet space between what we can calculate and what we cannot, between the certainty of gravity and the strange momentum of belief, the next bubble is already forming. And somewhere, perhaps tonight, its first investors are already gathering.